Inflation has been the focus for over 2 years now, so we may as well start our market update with a look at that. As you likely know, inflation has been cooling since the summer of 2022, but for now, it looks to have bottomed at 3% 3 months ago in June. Currently, inflation is tracking near 4%. Remember, the Fed targets 2%, so we are double that. The data is one of the drivers of interest rates. Towards the end of the third quarter, yields moved sharply higher, with the 10-year U.S. Treasury yield pushing from 3.95% to 4.55%. The 10-year has continued to move higher to 4.85% in early October. These current levels are 16-year highs, levels not seen since before the Great Financial Crisis. As yields have moved higher, borrowing costs have also moved higher. Think about things like home mortgages and auto loans. These are at double the rates paid just 2 years ago. For example, a 30-year mortgage was near 3% just 20 months ago in January of 2022, and now it's near 8%. You can see from this chart that the 10-year yield has been tracking inflation. And from a trend perspective, we have really broken out of a long-term downtrend in yields. Interestingly, if you look at this chart, you can see the break higher in the 10-year yield, which is the blue line. Since 1958, the longer-term average for the 10-year is 5.76%, and inflation using CPI is 3.68%. We may be seeing a mean reversion to more historical levels of inflation and yields. By that, I mean several years of higher rates and inflation than we have seen in the past 15 years. This will have implications for asset markets. While economic data has been strong, high yields are starting to cause some pain that is worth watching. New home sales are softening, with August total down 8.7% from July. The Conference Board's consumer confidence gauge fell to 103 in September, down from 108.7 in August. While the economy has been resilient, historically rate hikes will slow an economy down, especially the size and the speed we've seen this time, 5% in 18 months. The Fed indicated there may be 1 or 2 rate hikes from the current 5.25 to 5.5% range, also implying a higher for longer stance, meaning they may stop hiking, but it will take some time and much lower inflation before they actually start cutting rates. Remember, I said earlier that the Fed targets 2% inflation, and we are near 4%. One question we frequently receive is why are growth and inflation so high with the Fed aggressively hiking rates? One theme is fiscal policy, or government spending. The U.S. had a $2 trillion deficit in 2022 and is set for $1.5 trillion in 2023. As you can see in this chart, that doesn't just sound like a lot of money. It is a lot of money when compared to GDP. For some perspective, we haven't seen debt to GDP like this since the World War II era. This has gone a long way to counteract rate hikes in terms of economic activity. We now have a new war in the Middle East. For markets, the global energy supply is even now more fragile and will continue to support higher for longer inflation. For stocks and bonds, historically these types of conflicts have a limited impact as long as the conflict remains local. Should this escalate, it would be a sharp headwind for risk assets. Now let's take a look at the market performance in the third quarter, starting with equities. The S&P 500 was down 3.3% in Q3, consolidating after a strong start to 2023, bringing its year-to-date gains to 13%. The Russell 2000 index of small-cap stocks was down 5% on the quarter, widening its year-to-date gap against the S&P 500 to 11%. Large-cap stocks have continued to outperform small and largely from growth-type companies. We noted last quarter that in the U.S., we are seeing extremely high levels of concentration, meaning roughly 70% of the S&P 500 return is driven by a small number of stocks. These stocks were down in the third quarter, but continue to have outsized gains on the year. Let's take a closer look at this concentration now. Many of these stocks are considered to benefit with the growth of artificial intelligence and technology themes. These tech companies have demonstrated solid earnings growth, but those earnings recently have not kept pace with their returns. As such, the earnings multiples reflected in their stock prices have expanded significantly. The forward price-to-earnings ratio of the 10 largest stocks now sits at 25.9 times, which is more than 45% higher than the multiple of 17.8 times for the overall market. Looking at the graph on the left, you can see below that the top 10 stocks are near 32% of the S&P 500, and this has accelerated from levels near 23 in 2020. Looking at the graph on the right, the earnings of those same top 10 stocks as a percent of the broad earnings of the index, this has fallen from over 30% in 2022 to 21% now. This does not support the idea that this trend of sharp concentration will continue indefinitely. Now, looking at international stocks, global economies and their stock markets were also showing mixed trends in Q3. International stocks measured by the MSCI EAFE index were down by 4.1% on the quarter, lowering their year-to-date gains to 7%. China remains a disappointment amid paltry economic growth and continued uncertainty in the real estate market. Approximately 70% of household wealth in the country is tied to the now uncertain value of homes. Chinese stocks, measured by the MSCI China A shares, were down 3.5% on the quarter and 9.7% for the year. On the other hand, Japanese stocks were up 2.2% on the quarter and are higher by 24% on the year. These are now at a 33-year high. This can be attributed to the more accommodative monetary policy adopted by the Bank of Japan in recent years. Fewer rate hikes and balance sheet reduction have resulted in a boon for the Japanese economy and the markets. Meanwhile, Europe continues to experience anemic growth, and their equity markets continue to underperform those of the US. We mentioned the extensive fiscal support and the huge deficits the US is running. The majority of Europe and the developed world is not growing debt at this pace. Should the spigot of fiscal support close in the US, we'd be primed for some international outperformance. Shifting gears a bit, before we talk about bond returns, let's quickly focus on the US yield curve. Specifically, take a look at the right half of this chart. This is a visual representation and helps explain another quarter of poor bond performance. The blue line is June 30th and the green line is September 30th. You can see from the right side of the chart a sharp rise in the green line, which shows how much bond yields have risen in the longer dated bonds. Notice the yield curve became less inverted, meaning the longer dated yields are rising to levels closer to shorter dated yields. Historically, this has been a signal for weaker economic growth over the next several quarters. The US bond market experienced a 3.2% decline in Q3 as yields rose. Remember, when yields rise, bond prices fall. On the year, the Bloomberg US Aggregate Index is down 1.2%. Unless there is a significant fourth quarter rally, the major bond indexes are on track for their third consecutive year of declines, a trend that's pretty much unprecedented. We've already touched on the stronger economic data that's helped drive bond yields higher. Higher for longer should remain a theme until inflation is closer to the Fed's 2% target. Lastly, as the US continues to run multi-trillion-dollar budget deficits, the funding that comes from issuing more bonds to take that new supply, yields sometimes need to be higher. That being said, looking at the past 10 years, bond yields have never been more attractive. Looking at this chart, the blue diamond represents the yield to worst, the lowest possible return of a bond that operates within its contract without defaulting. These are either at the high or near the high for the past 10 years, meaning bonds look cheap versus the past 10 years. One might say that these assets are finally putting the income back in fixed income. Given these valuations and leaning into the history of bond market cycles, we continue to think bond markets will remain an integral part of a balanced portfolio.